All right, welcome to this basic understanding of using the DOM. The DOM is kind of composed of a few simple elements. We have our price column to understand the prices that we'll be trading in the market. It shows you where each individual tick increment occurs. It's helpful to know just how far the market tends to be trading when you're looking at multiple DOMs as well, to note whether or not we've ticked up or we've ticked down. This is the bid column. In this column, we have people who are advertising that they are willing to buy through the use of limit orders. Not necessarily that they will buy, but that they're interested to buy. The reverse is true of the ask and or offer column, that they're willing to sell through advertising, but not that they will sell. Most feeds by default tend to give you at least 10 levels of depth. It's hard to draw with this pen, but 10 levels of depth. And that gives you at most usually 10 prices to understand where there's willing buyers and willing sellers. Now the market will move through these units through the use of market orders. We can see this on the inside prints. If we have an advertisement of, say, 3 to sell and there's 43 people willing to buy, you'd want to see for prices to move, either someone stepping in with a market order to buy these 3 off these sellers, or for sellers to sell into these willing buyers. It's important to know in that situation, to make prices move, is not that there's more buyers or more sellers. It's just who's the more aggressive buyer or seller, who's willing to step up and take the market a tick in a certain direction. It tends to be good to also have a volume profile column to understand a sort of history of where people are most interested to do business, because this is all a business. This is all the auction. You want to know at which prices gives you the chance to get in and out of the market at a reasonable price and speed. To join into this market orders, join into the market, you want to be placing in your own orders. If you're interested to be a passive buyer, make sure to be below the market. If you're interested to be a passive seller, make sure to be above the market. If, say, you want to be aggressive, then just start crossing into the bid. I have these highlighted as the darker colors on the ladder. Let's say I wanted to be aggressive and I wanted to sell. I'm now into the market. If I want to get out, I can be aggressive and buy out. When we place our bids passively, you want to be below the market. And if you want to place an offer passively, please be above the market. These push your limit orders, and where you wait to see to get a fill. Once you're filled, you can be passive to cover the trade or aggressive to cover the trade. To be aggressive, you just cross the spread. You'd want to mark it in or mark it out. You can do so by either clicking into the prices that are highlighted a darker color, or in most platforms, you can set up a hotkey or a button to just hit market. So let's get ourselves into a sell. I have a possibility of making some profits by either dragging up my bid. Or to be aggressive, I can just hit into the bid. Or hit into the offer to exit at market. And that is the basics of entering and exiting the market, either passively or aggressively. It's prudent that for most chart traders, they tend to watch the market at, let's say for scalping, a minute by minute basis. The amount of trades that you can complete within a minute can be, let's say even in this instance, I could look to take some trades out of the market. If it takes longer than a minute, somebody else could be looking to exit off of me. At times where the Dom trader could be watching more carefully, when times come to execute, you're already watching the place where your orders will actually enter into the market. If you're watching a chart, at times you'll have to switch over towards your Dom to enter the orders that you're interested in. That split moment that you're dragging over from your chart to your Dom, a pure Dom trader could have already been in and out of the market, looking to even exit off of your poor timing. The same goes for when you are entering into the market. You can look to exit a trade at a much quicker price. If there was something that shot you in, let's say in this instance, I was looking at this dip in the profile, some low volume. If we cross back above that, I can look to profit and then place my stops within profit here. Oops, that should have been an exit order. And I'm out. As for most chart traders, they'd be looking to place their stop orders not at market events or order flow events, but they'd be looking at where their last candle high or low could have been. And that becomes a subjective way of placing a stop, as the same 1 minute candle, if you were to drop down to say a tick chart or a 5-second chart, those highs and lows would change drastically as well. So it tends to be good to be just a pure Dom trader, to do all your observation and execution in one go. And that for most scalpers, their entry and exits is going to be off the backs of those chart traders looking for those highs and lows to either enter or stop out of their trades. That's why it helps to use a Dom to alleviate symptoms that could be occurred of hopium, we'll say. That moment where you get into a trade and you just hope that it doesn't hit below the candle that you thought would have been the bottom or the short-term bottom. It also helps that when you're watching the Dom and you see these orders going through, you could at a moment's notice decide to cut at a quicker loss, and in turn minimizing your losses before it even hits, let's say, a generic 8-tick stop in this market. Because as the market, will say, finds a place of value and it goes back and forth in this area, you get this moments of, oh my, will it or won't it hit my stop? You have your targets close, you have your stops close, and it straddles between them, and you're at the edge of your seat to see which gets hit first. The Dom trader could be going in and out within those small tick spreads, hitting for 1 or 2 ticks at a time, while you're waiting for your 8-tick profit or 8-tick stop. The 8 trades they make within that moment is the target you would have had, but they did it safely in the way that they're ready for the next trade. They don't have to worry about their stops or their targets getting hit. They're waiting for the next trade, the next instant where they can get a few ticks out. If you get into a trade and what you expected doesn't occur, get out. You have the ability to get out quickly. Let's say for this instance that I wanted to trade off of a retrace of this move. So I'd go in, I to good for a bid. I place my stops below. I can get out for that trade. If it had gone below what I thought the retrace could have been, it'd be a quicker exit for me. I'm already ready to get in out with my small stop loss. And I'm ready for the next opportunity. Well, thank you for joining us for this DOM Basics video. It helps us if you like, share, and subscribe, and also allow your friends to come onto the video and see if they also would like to like, share, and subscribe. Thank you, and we'll see you in another video. Goodbye.